Johnson & Johnson has a very poor year, down 15% year to date. It is trading towards its 52-week lows with a yield of just over 3%. And after the spin-off, is this a company that looks to be undervalued, and should we be adding this? We're going to take a look at the historical performance of Johnson & Johnson. We're going to look at their income statement, their top line revenue, as well as their bottom line net income growth with their updated earnings. We're going to look at the balance sheet, the health check, total cash versus total debt. We're going to see how well they've performed on a total return versus some competitors over the last 5 years. We're going to dig deep into their dividend safety, some important financial metrics you need to understand before investing in Johnson & Johnson, and we'll take a sneak peek at what the institutions are doing if they are buying or selling. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. Now, they are down 15% year to date. Investors holding this for over the last 10 years would be up around 60%. Now, we do see it hit its peak at around $8 or $180 in 2022. But is this one that we can see the share price double over the next 5 years and that yield on cost grow to double digits? And what is our acceptable buy price? Let's find out. Now, in terms of the income statement, we like to see 3 to 7% growth year on year. $81.5 billion in 2018. January 23, $95 billion. So some nice growth over the last 5 years. And in fact, we can see the trading 12 months. So we should be getting that annual report for Jan 2024 in around 2 to 3 months. And we can analyze it. But it does look like there will be some nice growth into 24 as well. On a more granular level, we actually see increases every single year, which is always good to see. Some years better growth than others. And we'll analyze the last 10 years percentage-wise too. Bottom line, what story do you tell us? Well, $15.3 billion in December 2018, $17.9 billion in 2023. So again, we can see there, right there on the bottom line, an increase over the last 5 years. And we also see the trailing 12 months showing some increase as well. Again, we will analyze this when we have the data. On a more granular level, we do in fact see some very small decreases on the bottom line from 18, 19 to 21 before picking up again in 22 and then dropping in 23. So some inconsistencies across the board there, but we do see both top line and bottom line increase over the last 5 years. Now, quick health check, total cash versus total debt. We see the cash and short-term investments at $19.8 billion in 2018. Now, latest quarterly report shows this has increased fairly significantly to $23.5 billion, so they do hold quite a significant amount of cash. And when we compare that numerically and directionally to the total debt, well, we see this has gone from around $30.5 billion to $29.9. So their total debt has decreased very slightly, but their total cash has increased fairly significantly, so that is positive to see, and we can see why these are effectively rated a very high balance sheet score. In fact, the highest balance sheet score in line with Microsoft, AAA. Now, Johnson & Johnson, Merck & Co., these are other ones. We have Eli Lilly and Company, AstraZeneca, Pfizer in the same industry, the pharmaceuticals. Now, year to date, Johnson & Johnson, with those dividends reinvested, are down 12%, one of the worst performing in the industry. And when we move to the last 5 years, we see a mediocre 19.41% return. So that does include those dividends reinvested. Again, fairly poor. But I would mention that past performance is never an indicator for future. Now, dividend safety, before we jump into this, let's take a quick look at the institutions. 68% institutional ownership. Now, $22 billion worth of shares have been sold by these institutions over the last 12 months. But a lot more, $38.6 billion, in fact, have been bought in the same period. But it is interesting to note in Q3, so the latest quarter, a significant more amount of shares were sold than bought. However, over the last 3 quarters prior, the opposite is true, with Q4 of 2022 being a large buyer by the institution. So overall, institutions do prefer buying JNJ than selling, but again, do bear in mind we're not copying institutions and doing our own due diligence. Now, very quickly, their latest earnings for Q3, they did beat on the earnings per share and also the top line, so positive to see. And the last 2 quarters, so Q1 and Q2 of 2023, they did again beat on both earnings per share and revenue, so that is positive to see. And when we compare their Q3 23 versus Q3 22, we see they beat on the top line by around 7%, had a significant larger bottom line than last year, And again, earnings per share, net profit margin, operating income, all the same, all very, very strong and above the last year's numbers. So that is good to see as an investor. Now, dividend safety score, the safest score you could get, 99, very safe. Market cap, 366 billion, so it is a mega cap company. Now, the last recession, what did they do? Well, in fact, they increased the dividend. Negative 6% sales. Now, this was not great. It is negative, but it is above the average growth of companies in the S&P, which was negative to a larger degree. And they did, in fact, outperform the S&P with a negative 27% return versus the S&P's negative 55%. Now, this is a very consistent company. You know what you're getting with them. 5.3% increase in April this year, above the 4% inflationary target I always say to get as a minimum. 6% over the last 5 years, very good to see, and 9% over the last 20 years. So I would say that is very positive if you were getting 9% year on year with this company. It is very consistent. You do know what you are getting with Johnson & Johnson. They are also a dividend king. They have been paying increasing dividends for 50 years or more. And in fact, they've paid dividends uninterrupted without a reduction for over 100 years. So that is very incredible for any company. Now, dividend yield theory, it does state the company is undervalued when the current yield is sitting above the 5-year average. So what we can see right now, 3.13 versus 2.68, we do have our first sign of undervaluation. Bear in mind, though, we don't look at any of these models in isolation, and we will draw our conclusions towards the end. Forward PE 14.4 versus 16.4, another sign of undervaluation, and we do see it sitting slightly lower than the sector PE of 16.1. Now, free cash flow, very important to look at. Ignore the earnings, it is susceptible to manipulation, as we do tend to show you on the channel. Below 60% is my preference. It does mean, in my opinion, management can offer those double-digit increases. Well below 60% over the last 10 years, other than 2022 where it did creep up, but it is expecting over the next 12 months to come down to around 55%. So very positive to see, and I would like to see a slightly higher increase in 2024 of around 8 to 9%. Free cash flow per share, 492 in 2013, 655 in 2022. So it is increasing, but do note it did start dropping from 2020, although 2023 it is expected to go back up. So lots of positives to note for Johnson & Johnson. Now, sales growth 3 to 7% is what we target. They did have 1 year of negative growth, and we can see a few years of very mediocre under-inflation growth. But over the whole period, what we do note is that it has increased by just under 50% from 71 billion to 95 billion over the last 10 years. And on top of that, they also do share buybacks, returning excess cash to shareholders' pockets, 2.88 billion in 2013, 2.66 in 2022. ROIC, try and aim for at least 10% or more in the companies you invest in. It means management are able to effectively allocate their capital. And Johnson & Johnson, very, very consistent between 18 to 23% every single year. Very positive, with the trailing 12 months coming in at a very nice and high 27%. Both operating margin and free cash flow margin, not much to say other than the fact they are hitting well above the minimums we look for on both of them. So that is a good sign of a company. And the net debt to EBITDA, as always, it does directly correlate to the dividend safety. Shows us the number of years it would take the company to effectively pay off all of their debt and net of cash on hand. And it's below 1. It would take Johnson & Johnson around 0.53 years to pay it all off in 2022, with 23 expected to be significantly lower at 0.19. So that is very positive when you are investing, to invest in companies that have a very strong balance sheet. Now, as always, we'll run them through our valuation model. If you enjoy the content, values being provided, smash the like button, hit the subscribe button to be continually notified of these videos as they drop. And if you do want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment. Jumping into the first stock, we have the effective stock ticker JNJ, earnings per share 532, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remember, the higher the yield, the lower the intrinsic value, but this has been the first time in a while where that yield has come below 5. Gives the intrinsic value of $104. Now we can see that is significantly lower than the current trading price and lower than the 52-week low, showing signs of overvaluation. But as always, do bear in mind we don't look at any of these models in isolation, and we will draw conclusions towards the end of the episode. We then move on to the multiples valuation model. Companies in a similar sector and size. We have companies like Bristol Myers, AstraZeneca, the ones we analyse on the 5-year return. Stock price, EPS, P multiples, average, multiplied by the earnings per share of JNJ. to get a stock price of $158. Now, when we take a look at that, that is above the current trading price, very marginally, around 4 to 5% upside, but still within the 52-week range. You could argue reasonable valuation / some small undervaluation. Dividend discount model, well, very consistent, around 5.75%. Forward looking, I have gone for exactly the same, although there are people who argue you should go lower to be more conservative or higher for whatever reason, so grab a copy of the model and you can play around with these numbers. Gives a DDM price of 224. Now that is above the 52-week high, showing strong signs of undervaluation in the current market for JNJ. We then move on to the DCF model, where we have the free cash flow year on year. Average growth rate at 3.6, analysts estimating between 8 to 10% forward looking. With our discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to get a DCF price of $204. Again, above the 52-week high, showing some nice signs of undervaluation in the current market. Now, the intrinsic value, as always, is just the average of the 4 models. And if you are enjoying the content, value is being provided, do smash the like button. It helps the channel grow, helps push it out to other investors. And don't forget to hit that bell button so you do get these videos dropped to your doorstep as they deliver. So the intrinsic value at $172. Now, if we start off with a 10% effective margin, now that is if we believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of people will say, you know what, Johnson & Johnson deserves that. For those that do, it's an acceptable buy up to $155. Those that are looking at 15%, it would be a buy at around $146. And those who are looking for a much larger at 20%, it would be a buy at around $138. And we can see the 52-week low was around $145. Now, personally, this is one that I do hold in my portfolio, and I do like to add it every now and then when it does dip. With my last purchase, personally, around the $147 when it was towards that 52-week low. As always, though, do let me know your thoughts in the comments below. In terms of Wall Street, well, they believe the share price to go up to around $176, higher in fact than our calculated intrinsic value. So they do believe there to be some very strong upside to the current trading price at around $24 per share. As always, though, do let me know your thoughts in the comments. Is Johnson & Johnson one you are adding to? Is it one that maybe you think is overvalued or has some room to come down? With a lot of money being moved into stocks, tech stocks, in fact, it does look like a lot of these pharmaceutical companies, healthcare stocks, have been undervalued. As always, if you do enjoy the content, values being provided, hit that like button, hit the subscribe and bell so these videos are dropped to your doorstep every single day. And finally, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. As always, have a great day, catch you on the next episode and take care.